morning and welcome to the Ashworth Weekly Market Update. We are excited to have you here with us, and we have just a little bit to cover today. Everything that we're looking at right now has to do with interest rates, the Fed, the economy, where the economy is, and what's happening going forward. I want to show you this chart here for just a minute, and this chart is showing us what it's trying to tell us is that as we look at the economy going forward and what has happened with the economy, whether or not it was better than what was expected by the economists in the Fed or whether or not it was worse than was expected by the economists in the Fed. And what you can see here is that the black line in the middle is neutral, and anything above the line indicates that the economic data was better than what was expected. And anything below the line is indicating that the data that came in was less than what was expected. And if you look at January 2023, kind of mid-January on that blue line, what you'll notice is that it went below the line, but then dramatically went above the line. And now as we've had the small bank crisis and other things that have kind of happened in the economy, we're seeing a slowing in that growth versus expectations. And let me give you a few examples on this as far as what's happening. Even as of March, they were projecting that GDP growth in the economy was going to be coming in at roughly a 3.5% increase. And it came in at only a 1.5% increase, and so less than half of what was originally projected, even just a couple of weeks ago. And there's been decrease in orders from manufacturing. In fact, it's right now at the lowest point that it's been since 2020. The unemployment in March, even though it's still lower than the average, it's still higher than what it has been over the last year, but it is decelerating substantially from where it was even 3 months ago. So looking ahead, one of the things that we're trying to determine right now, and we'll see what happens as the Fed meets again, but the economy is definitely slowing, not only in the banking industry. We see in the banking industry, we talked a little bit last week specifically about the fact that the banks are not lending as much as they were even 6 months ago. The tightening of credit, which means that there's less money in the economy, which means that people have a harder time getting loans, which also means that it's harder for the economy to grow because there's just not as much money to fund new growth in the economy. And so with that, with unemployment the employment situation slowing down a bit, with orders slowing down a bit, with everything seeming to be slowing down right now, as I listen to the Fed and what the tentativeness of what they're saying, and again, they haven't committed to anything, but they do kind of tip their hand a little bit from time to time. But the thought process right now is that on the next meeting that the Fed has, that it may be a pause rather than a rate increase as they had anticipated just a little while ago. And if we get a pause now, and if the economy continues to detract or contract a little bit more as it continues to go forward, there are a number of economists right now that are projecting that the interest rates may actually come down at the end of 2023 rather than continuing to increase like that they thought that they might have to. So this is good news and a little bit of bad news. So it's kind of both mixed into one. The good news is that if we can get the Fed off the rate hikes and have them in more of a just a hold pattern, the economy will be able to figure out what each individual corporation needs to do to be able to manage their companies in this particular environment. One of the things that we notice all the time is just that these corporations that you're invested in are very resilient. They look at the economy, they look at what is happening with their orders and with other profit matrix that they keep. And they are constantly adjusting based upon what is going on in the economy and based upon what's going on both nationally and internationally. And so we see this great resilience of ingenuity, just redoing, refining, retooling, and coming back into the market even stronger than they were before. So I think this is long-term good for the economy. I think that we will have a little bit of a slowing economy this year. We're definitely not going to have the growth that we had previously. But one of the bright spots of the economy right now is the bond market. Back 6 months ago, in fact, a year ago, bonds were trading at a yield of about 1.5%. Right now, they're up around 4.5%, so they have increased dramatically as far as the overall yield is concerned. And as the Fed pauses their interest rate, that 4% will continue to go year by year by year instead of the 1.5%, which will give us a much better return in the bond portfolio. If in fact the interest rates start decreasing this year, you'll see a bump in principal in addition to the yield on the bond funds, and a likelihood that we could even recover most of what was taken away from us last year in the bond market. So we're fairly optimistic with what's happening. We know that we have some things in front of us that need to be addressed, but we again have great confidence in the resilience of corporations and their ability to kind of manage through these types of things. There's still a lot of cash on the sidelines. Corporations still have a lot of cash to be able to wade through much of what's going on right now. And so from a long-term perspective, we're just not very concerned about whether or not the corporations are going to be able to return a profit. We believe they will, and that will start showing up in returns here probably towards the end of the year. At least we're hopeful of that. Anyway, that's it for today. Thank you for tuning in. If you have friends, neighbors, friends, neighbors, associates, or anybody else that you feel like might benefit from our presentation, our weekly webinar, please feel free to forward this to them. And with that, we thank you, and we will see you next week. Goodbye.